Well, welcome everyone to tonight's webinar, proudly brought to you by Real Estate Investor. Tonight we'll be covering how to boost your cash flow with dual living investment property. So my name is Dennis Wong. Welcome along. Thank you very much for taking an hour out of your time tonight to join me. For those that are tuning in for the very first time, I hope you get a lot of good content and tips and tricks in terms of how you could potentially progress with your property investing journey, or for those that are seasoned investors, perhaps if you're looking at balancing your portfolio with some cash flow opportunities, this is definitely a webinar for you. So if you are tuning in for the very first time and you've never been to one of our webinars, just to ensure that you get the best experience out of tonight's webinar, I do recommend that obviously have your speakers turned up high, and if you're running any programs like Outlook, Dropbox, or any downloads, I recommend you just switch those off or pause it for the next an hour, just so you get faster internet, and obviously you'll get better quality audio as well. Now, your microphones have all been muted, but you do have the opportunity to ask questions, so feel free to type it into the questions section on your GoToWebinar control panel there. We will try to answer your questions during the content itself, but we will have plenty of time at the end with the Q&A session if there's anything that we can't cover. So my name is Dennis Wong. You probably heard me on some previous webinars as well. So, you know, the whole purpose of these webinars is just to give you a lot of good educational content. For those that are obviously starting out, or even those seasoned ones, there's always something that you can learn. I've been investing myself for over the last 10 years. I've got experience with renovations and cash flow properties myself. And look, tonight we are lucky enough to be joined by McCabe, who's on the webinar tonight. He will be joining us a little bit later on. He is a senior property strategist here at Real Estate Investor. He invests himself, and he has a very strong background in mortgage broking, financial advisor, and he's also been a property consultant as well. But I'll let him talk a little bit more about himself a little bit later. So just a quick general advice disclaimer before we do kick off into the content, just to advise you that, you know, the content of this presentation is really just an overview. It shouldn't be considered as a comprehensive statement. We just want to give you obviously just some general information, and we obviously don't understand your personal objectives, financial situation or needs. So before making any decisions, please do ensure that you engage in some advice from a financial advisor. So look, for those that are come to Real Estate Investors first, or the first Real Estate Investor webinar, if you don't know who we are, this line really sums up who we are and what we do. So we essentially help investors build and manage their property portfolios. And we've been around for over 10 years now, and we've guided and helped thousands of clients to plan and purchase property. Since 2006, we actually originally started as a magazine. And you know, the whole aim or our whole purpose is really to help clients build wealth through property. We give you access to a lot of superior real estate data, which you know, previously was really only limited to real estate agents, mortgage brokers, and the banks. And obviously, with, you know, the improvement of technology and companies like ourselves, we give you access to the same systems that they've got. You know, and really, whether you take up whatever service that you utilize through us, you know, we're really here to help you reduce your debt, you know, help really focus on helping you achieve your goals, and really give you the freedom and the choice to, you know, decide that if you want to retire early, you can do so. If you want to travel, maybe focus on investing full time, gives you really those options later on in life. And we currently have over 260,000 members within the Real Estate Investor community. We are a publicly listed company. REV is our code, and we have a very strong and property-focused board. Simon Baker, who was the former CEO of realestate.com.au, and also Anthony Catalano, who is the current CEO of Domain. And look, we partner with other companies who specialize in different areas that relate to property investing. Pricefinder is our data company, and we do partner with Domain, and we provide a lot of data to your investment property magazine as well. Washington Brown, Quantity Surveyors. Now we're actually going to be running a webinar with them in a couple of weeks. I do strongly encourage that if you can make it to tune in. That focus of that webinar will be on the federal budget and the changes to depreciation that's potentially going to affect you moving forward. So look, before we get into the content, I might just ask a couple of questions just to get an idea on the audience tonight. I guess the first question I just want to ask is, do you guys currently have a property strategy? And I will share it with the audience as well. Obviously, I won't reveal who you are, but just an idea on whether you have one. Perhaps you don't have a strategy, or perhaps you're not even too sure what a strategy is when we ask that question. And this will obviously help with the way that we're going to tailor tonight's content as well. So we're just getting just over 50% voting, so thanks very much for your participation. If you just click on screen there, that'd be much appreciated. It obviously gives you an idea as well that you're not alone in this, and how many other people out there are in the same boat. So I'll just keep that on for another couple of seconds. All right, so I'll just close that off now, guys. Thanks very much. And I'll share that with the audience. So we've got 69% that have a strategy, so fantastic. And we've got 26% that don't currently have a strategy. That's okay. It's all about perhaps getting some education, and perhaps after tonight's webinar, you'll get you thinking, and maybe you'll start to plan a strategy or get some help with it. And we've got 6% that's asked, what is a strategy? So look, I'll let Mitch talk a little bit more about what strategy is a little bit later on. That's his bread and butter. But look, dual income is definitely a strategy that some investors focus on. All right, so I'll just ask one more question before we get started. Does your strategy involve dual living? So it'll be interesting to see whether tonight people already are looking at dual living, or have done so in the past, or perhaps you're planning on a dual living strategy, or no, you're not, just getting some information, or perhaps you're just not sure. So if you just click on screen again, guys, and we're getting some very fast voting, so thank you very much. I'll just keep that open for another 5 seconds. And we're getting a very, very spread in terms of answers here. All right, so thank you very much. So I'll close that off now. So we've got 60% that are planning to, so you definitely come to the right webinar. 11% no, and yes, they've already done so, so excellent. And perhaps for those that have said no, this perhaps might give you some ideas on what dual living is all about, and help you whether to proceed with this strategy or not. And we've got 17% with not sure. All right, so let's hide that. So let's get straight into it. So what is a dual income property? So essentially the best way to describe it is that it's a single property that can provide 2 incomes to an investor. So it's essentially about maximizing the space that you have, and trying to get some more rental income from it if the council and regulations in that particular area allow you to do so. And some examples of dual income properties include duplexes. So here's an example there of a duplex. It's obviously a shared driveway. They do have separate garages there. Properties with granny flats. So here's an example here, probably of a high-end granny flat there. It's a standalone dwelling away from the primary residence. And we have dual living as another example as well. So they're the 3 that we're going to be focusing on. You can see in that example there, it's a upstairs, downstairs split. Looks like it's one house, but you can see that unit 1's actually upstairs, and they've got the left-hand garage, and the downstairs has the right-hand side garage, and is basically is consisting of the ground floor. So what are some of the advantages of dual income property? So like I mentioned, you can maximize the potential of one block of land. So you might have an existing house, and you might be able to modify it to bring in some extra income, and that essentially allows you to increase your gross yield, but also your net yield. So you essentially got 2 income streams if you are renting out both properties. Generally, you can actually acquire a dual income property in the same price bracket as a single dwelling property. So if you're looking at, say, a 4-bedroom, 2-bath, 2-car garage house in a suburb close to the city, you could actually get a duplex or a dual living property with the same configuration, but perhaps a 3-bed, 2-bath and a 1-bed, 1-bath for about the same price. Obviously, the advantage of the dual income is that you get 2 income streams. You can capitalize on higher rates of depreciation. So obviously with 2 properties. You know, you've got the ability to depreciate 2 lots of ovens, 2 lots of sets of carpet, curtains, all those sorts of things. Now, if you're buying a new, perhaps a new dual income property, you've got the potential to create equity uplift on completion of that property. So it may take 6 months or a year to build. So you essentially pay at today's rates, and on completion, you may get an instant equity uplift. So the value of the area has gone up, and so has your property. And also, depending on the dual income property type, you may be able to strata title it as well. So what that means is you might have a duplex, it's on one title. Let's just say it's worth about $500,000, 500,000. If you strata title it, so that one property now is on 2 separate titles. You can sell one off separately. Those properties on a smaller block size is probably worth about the same price. So that's definitely an advantage. Definitely it reduces your exposure of risk to vacancy or non-tenancy, because if one decides to leave, you actually still have income coming in on the other side of the property. For those that are looking at actually buying and living in it, then you can live in one and rent out the other part of the dwelling, which will obviously help with your mortgage repayments. So the first one we'll look at is just give you an overview of the duplex. So these are purpose-built 2 dwellings, and they're usually on one, they are on one property, and they usually will share a common central wall. So you can see this example here, central wall down the middle there, and you've got garages on either side. The duplex can be on one title, so you can actually buy them as one, but you do have the opportunity to strata title them, depending on obviously the zoning in the area, to get 2 titles, which means that you can actually sell them off individually. So whether you have one title or 2, you still can have 2 leases on duplexes. Now, obviously, by strata titling, then you've got the opportunity to create equity straight after that. So if it's in a good area, you've done your research, by strata titling, you can obviously then sell one off, and pretty much the proceeds of that you can pay down the loan of the one that you decide to keep. And duplexes can be attached or detached. So with the duplexes, they generally have separate driveways for each dwelling. Each side usually will have its own garage. Now, good layouts will generally have the bedrooms away from the living spaces from the other dwelling, to obviously reduce noise when people are trying to sleep, or tenants are trying to sleep in the bedroom. It does present like 2 separate houses from the front, so obviously 2 entrances, 2 garages. And look, usually if you want to get a duplex that's going to give you some strong capital gains, you want to make sure that you're buying in areas where duplexes are actually the exception and not the norm. You know, you don't want to buy a duplex in a street where, you know, every single house on there is a duplex. You want to be the unique one on that street there. Now, configuration is actually really important. So usually side by side, like the previous picture, or a corner block position is actually ideal. Obviously, with a corner block, you've got the ability to have the entrances lead into 2 different streets, so you never cross paths. Now, duplexes that are front to back, or one where one is at the back, they're not ideal, because obviously you're going to need side access to the back, and if tenants are walking down the side, passing the primary residence bedroom or bathroom late at night, depending on obviously the tenant in the back, it could be quite noisy, and obviously lacks a little bit more privacy. So here's a couple examples of a couple of floor plans. So here's one here. You can see that unit 2 on the left there. We've got the garage on the top left-hand corner there. Apologies for the picture just being chopped off there, but there is a bedroom on the top right there just behind that garage. But you can see there next to the garage, there's the unit 2 entry. There is an entry from the garage itself as well. And you can see that most of the bedrooms, apart from the one on the top right, not touching the shared wall. And then we've got unit 1 on the right, entry at the front, garage again with the entry from the garage. And then we do have a bedroom on the top left-hand corner there that is touching the wall, but it is next to another bedroom. Now we have another floor plan here. This is obviously just a single garage, same sort of setup. You can see there's the entrance at the front for unit 1, just to the left of that garage. All the bedrooms are on the left-hand side. Common wall then in the middle, and then you've got living areas like the kitchen, meals area. So this was actually probably a really good configuration. All the bedrooms are either on the left or the right hand side of each dwelling. So what are the pros and cons of a duplex? So for the pros, pricing, like I sort of touched on, they can be more affordable than a lot of houses in the same area. So, you know, for the same investment, why not get two streams of income coming in? Or, you know, if you're if you're looking at actually living in it, then, you know, you can live in one side and rent out the other. Perhaps if it is for investment purposes, then you can sell one if it's strata title and then hold the other. And then, like I said, if it's in an area where there's good growth, and by strata tiling it and being it on a smaller, by strata tiling it into two, the value of it is pretty much the same as it being one, then obviously you can potentially pay off the loan for the one that you decide to keep or be close to paying it off. Now, this is a really good advantage. So unlike being in an apartment complex, a duplex, you only have one neighbor. So you're not going to get as much noise or issues with being in an apartment complex or a townhouse complex where there's a lot of neighbors that you're going to have. You are just going to have the one with the duplex. It is a low maintenance lifestyle for tenants, so that could be attractive if you're renting it out. You know, less space in terms of landscaping, gardening to upkeep, and there's no body corporate fees at all. So as you know, if you own units or townhouses, you can know these can be quite expensive. So with a duplex, you're not going to have that issue. So what are some of the cons? So tenants, obviously, no matter what type of investment property you have, that may be a con because they could be noisy or difficult to deal with. But even worse, if you're actually living on one side, it does make it obviously less desirable living right next door to difficult tenants. Less privacy. So, you know, depending on the layout of the floor plan, you know, if you've got outdoor space, that can, you know, obviously be intruding. Obviously, you can see next door what they're doing, all that sort of stuff. The common wall can just be a turn-off just for some tenants or for investors or for, you know, just a buyer. And obviously, smaller living space given that there's two properties within the one dwelling. So just got a question come through here. Mitch, you might be able to jump in here. Do you know, are there any cons with obtaining finance from your experience?
Well, look, it just depends on, I guess, more so where you're looking at investing. Cons as far as obtaining finance, not so much as in doesn't make it more difficult, but I guess the more so with the difficulties come in the town planning aspect. But yeah, as far as getting finance, it doesn't make it any harder.
Fantastic, thanks, Mitch. And look, just another question here: what is strata title? Look, strata titling is so you've got. I'll just go back to the example here. So strata titling is the ability to be able to create two titles from one. So if you look at these two examples, if you look at the bottom one there, so you've got essentially a duplex. You can actually buy them on one title. So what that means is when you purchase it, it's on one title. Your name's on it. You own both sides, like you would with a house. Now, strata titling gives you the ability, obviously depending on council zoning and regulations, if they allow you to strata title it, you can actually then create a second title for the other dwelling. So essentially now you've got two titles. And because you've got two titles, it gives you the ability to sell one off by itself. If it was on the one title, you wouldn't be able to sell one side only. You'd have to sell them both together. All right, so I hope that makes sense.
George has just asked, are there any cons with valuations? We'll get into, I mean, looking more so on the dual locks, but with the duplexes, it can be a little bit harder and they can be a little bit more stringent when it comes to duplexes, simply because more so the cost to build is usually a bigger dwelling, and that way some valuation companies, mind you, depending on who you're going with, this is always different, but sometimes they can be a little bit more stringent and it can be a little bit harder. So sometimes, yes, with duplexes. Dual locks, on the other hand, quite the other way. They actually are pretty favourable when it comes to valuations for dual occupancies, because we'll probably get into it, but it's more so on the size of the dwelling is a lot a lot smaller, so build size for, I guess, double the rent, and that keeps your costs down for build as well. So.
Fantastic. So I hope that answers your question there, George. All right. So the next option that we have is granny flats. So granny flats are usually self-contained. They're on the same block of land, and they're the secondary dwelling to the main property. So you can see in that photo there, you've got the house, which is the one with the air conditioner on the roof, and then you've got the granny flat on the left there. So granny flats will have their own entrance, the kitchen, bathroom, bedroom, and laundry. Now some may have 2 or 3 bedrooms. They might be a little bit bigger, but generally they might have just the one. And you know, for home owners that have a granny flat, they may sometimes use that to allow, you know, extended family to come stay. They may change it to a teenager's retreat, or it could be a man cave. So it's just something that obviously you can then turn into an income generating asset. Now it's generally freestanding, and again, depending on the state and regulations on whether you can have a granny flat or not, but all should always have a separate and unobstructed pedestrian access to that dwelling. So they generally will perform better the closer you are to the city centre, just because of the higher population there. So obviously from a rental point of view, it makes it easier because you've got a bigger pool of people that you can rent to, especially if they're single or they're students and they want to be close to the city for entertainment, restaurants, or uni, whatever it might be. And then just from a value point of view for the whole house, land obviously closer to the city is just going to be worth more, and capital growth for land it increases more closer to the city. And given the fact that there's a granny flat which gives you extra bedroom, bathroom as well, that's just going to add to that value. Now $100,000 is usually the starting point for building a granny flat. You can obviously get more, or you can get higher quality ones around the 130, 140K mark. Now, granny flats can turn a negatively geared property into a positive one, and good layouts ensure that there's going to be separate entrances, so tenants from the primary residence and the secondary one on the granny flat don't cross paths. So here's an example of a perfect granny flat, and you don't see these very often, where the granny flat, which is at the top, has its own garage. So generally you won't see that, but in this particular case you can see that it is a shared driveway, but the primary residence has a car space at the front, patios at the front too, and then you've got the driveway that leads right to the end. The granny flat, it's a 2-bedroom one, this particular example, and they've got a fence there that leads in a separate path that leads there. So this is probably a perfect example in terms of having a car space and being separated. But again, if you were going to be one family living in it, you can still use it as combined space. Okay, so what are the pros and cons? So the pros of a granny flat: pricing. Now, what I mean by that is that if you want to increase your portfolio, increase your cash flow, but you don't have enough of a deposit to buy another property, then you can spend only about $100,000 to build a granny flat, and depending on the location of your current home or the house as an investment, you may be able to get an equity uplift, get some extra cash flow as well. So when you go to your bank or your broker, your serviceability and your equity position is going to be a lot better. Additional income stream, which is what we're talking about all tonight, boosting your cash flow. So again, you can live in the primary dwelling and rent out the granny flat, or rent out both, 2 separate tenants, add value to the property, additional spaces for relatives visiting friends, which I mentioned. And it is easier to rent out for short-term on websites such as Airbnb on stays. So again, depending on the layout, if you do have complete separate entrances, there's no crossover, that can be ideal for people looking at short-term stay. So what are some of the cons? So like the previous duplex, difficult tenants. So if you have any issues, you're going to have to deal with them, especially if you're living in the primary residence. Less backyard space or no privacy. From a primary residence point of view, you're not going to be able to Well, if you have a swimming pool there, obviously the back at the back there, there's going to be no privacy there. They might be able to see you swimming there. No secure garage space or parking space for the granny flat. So like I said, that previous floor plan is quite unique. Usually the tenants living in a granny flat, it's going to be off-street parking. And again, if you've got one in a great location close to the city, off-street parking is usually going to be difficult to find. And it could be expensive if you're going to need to get a parking permit. Granny flats can't be on a separate title, so that is a con. So you can't strata title a granny flat. A granny flat can't be sold separately. It's going to be part of the wholesale. So that's why if you ever try to search for granny flats, it's quite hard. It will usually be, you know, the house itself that's going to be presented from a sale point of view. And there are different rules in different states. So this is really important. Not all states allow for a granny flat. So in Victoria, a granny flat can only be rented to a person that's actually dependent on the resident from the main dwelling. Okay, so whereas some other states, it doesn't have to be. They can be completely non-related, and you can rent them out short-term or long-term. Dual living. So this is the third option in terms of being able to create dual income. So this is a purpose-built house. It's different to a duplex. Now it does have two separate dwellings within that house. It has two separate entrances, but it actually looks like one dwelling. So you can see this particular example here. You've only got the one door and two garage entrances. It does allow you to have two separate leases, even though it looks like it's one house. Strata titling is not available for dual living, so you can't sell one off on its own. You have to sell them both as one. And generally, the primary dwelling will be larger than the secondary dwelling. Now, there's two separate entrances, like I mentioned. And ideally, you'll have ones that, so again, the tenants don't cross paths. Each dwelling will have its own garage. All the main bedrooms from the main dwelling should be away from the common wall. And like I said, it presents like just a standard house with one entry at the front. Now, usually the second entrance is within the garage of the secondary dwelling, and there's also a secondary entrance, usually down the side of the house. Now, they're generally not detached, so it's usually one dwelling, so it means that you can actually build on a smaller lot, so you don't need a larger block size. Here's an example of one. You can see here that you've got the main dwelling at the top there, all the bedrooms on one side, and you've got the family, patio, laundry, and the garage along the common wall. You've got the secondary unit there, entry as a door from the secondary garage into the patio, which then leads into the actual main unit as well. In this particular case, it's just a one-bedroom unit.
We've just got a question. George has asked, is dual living such as this is owned valued as a single house? With dual living, because it's a single title, it's always valued as a single house. So they'll never look at it as two separate dwellings because, yeah, it's just on the one single title.
Just another question here. Dragoner just asked how long does it take to get a permit from council to build a granny flat? It depends on the council, Dragoner. So yeah, I'd get in contact with them and see if they can give you timelines on that. Okay, so what are some of the pros and cons of dual living? So pros, you get two incomes from one title. So that means a higher rental yield and potentially should be cash flow positive. Low maintenance, just like duplex in terms of less landscaping gardens to maintain for the tenants. There's no strata fees like units and townhouses in big complexes. Now there's no town planning or council charges if you're looking at a dual living opportunity, and they are cheaper to build than a duplex. And a real good pro of this is that there's only one set of council and water rates. So as an investor, you don't have two sets of council water rates that you have to pay for. It is just the one that you need to cover. And generally, if you're buying a new one, stamp duty is on the land component only. The cons. So can't be on a separate title, so you can't sell it off separately. It has to be sold as a whole dwelling. Living close proximity to another tenant, that could be a turn-off. Repairs. So what I mean by that is because you'll have multiple kitchens and bathrooms to maintain. And for the secondary unit, it can potentially be a little bit noisy, given that that's usually going to be next to the common wall. So what I've done is I thought I'd just do a cash flow example just to show you some numbers between a house versus a dual living opportunity. And using the pro membership tools, which some of you guys I'm sure are on, I was able to find an example of one, and I've just put some numbers together just to give you an idea of the difference in terms of cash flow and how that can really affect your income and your rental yield. So I found this dual living opportunity. It's an existing house. It's located in Lutwyche, which is 6 kilometres north of Brisbane CBD. Quite a nice leafy suburb. It's close to the Royal Brisbane and Women's Hospital, close to train station, transport, amenities, shopping centres, all that sort of stuff. So in terms of just a 4-bedroom, 2-bathroom house, I've just got some statistics here. So the median price over the last 2 years for a 4-bed, 2-bath was $862,500. The median rental for a 4-bed, 2-bath was $575 a week, and giving you a gross yield, the median gross yield about 3.47%. Now, I found a dual living opportunity, same configuration, 4-bed, 2-bath, but being dual living. Now, this was an upstairs, downstairs configuration. It was a 3-bed and 1-bath upstairs and a 1-bed and 1-bath downstairs. Now, the only thing just to be aware of when you're looking at an existing house, like an existing dual living, the one thing that you will need to check is whether it's approved and whether they've gone through council to get that approved. So from what I know, in my experience, that generally they're not, especially if it's an existing, like especially those in like Queensland. I know that those Queensland houses usually downstairs it doesn't have the appropriate heights to actually be rented out, and you know, if you if there was ever a fire or anything like that, then given that it didn't meet regulations, wasn't council approved, you know, insurance wouldn't cover it. So there's something to be aware of. Whereas with new dual living opportunities, they'll all pass all the requirements, council regulations, all that sort of thing. So you've got that reassurance. Now this dual living opportunity was asking $859, so it's just a little bit below the median price of the area for a 4-bed, 2-bath house. And the potential rental for the dual living was $900 a week, giving you a gross yield of 5.45%. Now, if we crunch those numbers further, now I've just got a couple some figures here just to give you an idea, some assumptions. So we've got the rentals there for the house and dual living, council and water rates. So again, like I said, there's only one council and water rates for the dual living. Insurance, now I've put a little bit of fat into the dual living. I don't think it will actually be $2,000 a year for a dual living. It'll be a little bit less, but I've just put some fat in there just to cover us. Just have a look at worst case scenario, what those numbers look like. Letting fee, management fee should be the same. Repairs, again, just a little bit more for the dual living. And interest rate and deposit we've kept the same. And using those assumptions, when I put it into Property Analyzer, you can see for the house that the gross yield's about 3%. The pre-tax cash flow is negative $8,355 in year one. And it reduces over the years, but it's still negative pre-tax. Whereas if you're looking at the dual living opportunity, it's positive. So after expenses, after the loan repayments, you're going to have a little bit over $5,500 in your pocket before tax. So you can really see the big difference there. You know, if those existing owners converted that, you know, you can see how much more extra rental income they can potentially be getting and adding to their portfolio. All right, so as part of Real Estate Investor, we've got access for our premium members to some examples. So here's a duplex example based out at West Wallsend, which is in New South Wales, 21 kilometres west of Newcastle CBD. This particular duplex is available at $835,000, just a little bit over. And you can see the configuration here. It's a 6-bed, 4-bath, 2-car, and it's an even split on each duplex of 3-bed, 2-bath, and 1 car. So you can see there, shared driveway, but completely separate entrances. The rental appraisal for each duplex or each dwelling is $440 to $480 per week. And we had a sale appraisal as well between $450 and $480 for each property. So these will be strata title. So you can see that if you did sell both of them off, it'd be more than the package price itself. So those appraisals were provided by First National. Now, if we look at those numbers in Property Analyzer, you can see that from a cash flow point of view, your pre-tax in year 1, 3, and 5, and 10. So in year 1, you're slightly negative, $768, but your after-tax cash flow, so with your depreciation benefits, given that it's a new property, you're going to be able to claim higher depreciation. You're $9,000 better off after tax. Now, for those figures there, I just actually used the low-end rental appraisal, so I was using the $440 per week. Now, if I actually use mid-range rental from the appraisal, so if it changes to $460 a week, you can actually see the pre-tax cash flow becomes positive. So we're a little bit over $1,000 in your pocket before tax in year one. So from day one, it's going to be cash flow positive. And if you look at after your depreciation and potential tax refund, then you're a little bit over $10,000 after tax positive. Here's another duplex example. This is based out at Griffin in Queensland, just 24 kilometres from Brisbane CBD. This package here, a little bit over $700,000. You can see the floor plan there, garage, 2 separate entrances as well. All the bedrooms not touching the common wall, so it's a great layout. 5-bed, 3-bath, 2-car configuration. And this one here, you can see the rental appraisal for the bigger dwelling of $395 per week, $325 for the smaller dwelling, and then we've got some sales appraisal there as well, $430 and $305. Now this particular one comes with a gold package, so I might go through obviously all those details there, but you can see the highlights there where you get a 20-year structural guarantee. There's a complete landscape package, silver light fittings and ceiling fans. You get an air conditioner in the living room and also the main bathroom, stone bench top. So you can see, with higher quality fixtures and fittings, you're going to be able to claim more on depreciation. So these are all of high grade. Now, if I put them into Property Analyzer as well, using the figures, you can see that pre-tax is negative in this particular case, but it becomes positive eventually. But your after-tax cash flow, so with depreciation, it's going to be positive. Here's a dual living example. So this is in Logan Reserve, 37 k's from Brisbane CBD. It's close to primary and secondary schools, major shopping centres is nearby. You can get onto the Logan motorway or the M1 to go up to Brisbane or down the Gold Coast. Logan Hospital, train stations all close by. So it's really, really conveniently placed. Again, the bedrooms are away from the common wall. 6-bed, 3-bath, 2-car configuration, just a little bit over $560 for this particular one. And you can see their dwelling, the primary dwelling, obviously bigger. Rental appraisals there for dwelling A, dwelling B. Again, comes with a gold package included with this dual living opportunity. And again, we put it into the forecast in Property Analyzer from day one. This particular one, pre-tax cash flow is going to be positive. So you're $1,802 in your pocket. After tax, with depreciation, tax refund, etc., it's going to give you a little bit over $7,000. So that was using the conservative low-end valuation. Now, if I use the mid-range rental appraisal, then the figures just increase. So if you're looking at boosting cash flow in your portfolio, these are definitely some good examples of how you can do that. Now, these are just examples that our clients have access to. May not be right for you, but it's all about understanding what your needs are. All right, so one poll before we'll get Mitch on to have a chat about strategy and some of the stuff that we talked about. So, what do you prefer as an investor? Are you looking at doing it yourself, or are you looking for some guidance to help you? So I'm just going to launch that on screen, and if you can, if you're looking at doing it yourself, great. We've obviously got tools to help you with that. Maybe you're looking at some guidance, maybe a bit of both. So it'd be just interesting to see, where you're at as an investor, whether you're a newbie or whether you're a seasoned one. All right, so just keep that over for a couple more seconds. All right, so I'll just close that off. Thank you very much. And I'll just share that with the audience. So, Mitch, look, we've got sort of an interesting split here. 67% looking at a bit of both, 19% do it yourself, and 14% that are looking for a little bit of help. So, thanks for that, guys. I'll just hide that, and look, I'll bring in Mitch now just to have a chat to you about what he does and a little bit more about strategy and some of the stuff that we've talked about.
Yeah, look, interesting results. Obviously, a lot of people like to have a bit of both, and I guess that's why you're here and why you're watching this webinar. I understand you probably have a bit of an idea of strategy, as most people sort of said earlier. The majority already had an idea of where they want to go, but then I guess it is always good to get guidance and get a bit of assistance. And at the end of the day, if somebody telling you what you need to look out for and to be, I guess, risk adverse. So like the simple things we like to look at if you're doing it yourself, and I'd imagine the 19% that said they were doing themselves would have this first one covered in the base. So the experience level, I would expect anybody who's done a project, or we're talking about granny flats as well as duplexes as well as dual-locks. The experience really comes into play. Granny flats, the majority of people that I'm speaking to are people that are, I see, living in, believe it or not, mostly in Sydney, that they want to turn their backyard and make a bit of income out of it. So they turn it into a project that they like to be hands-on with. If you haven't got the experience to do that, or you haven't done it before, obviously it's going to be a real experiment. Obviously you've got to start somewhere, but it does help to get a bit more guidance and know where you're going. So I guess the questions that we ask when it comes to experience level is, have you done it before? Do you know what to expect? Do you have the time to do it? If you're looking at a granny flat and you're looking at putting some time into maybe being hands-on with it, do you have the time to do that? And do you want to be hands-on? As far as waiting for build times with duplexes, do you know that duplexes take longer to build? As a planning stage can take a lot longer. Have you factored that into your feasibility study sort of moving forward? And do you have the time to sort of devote to the planning? So there are a lot of questions that we sort of like to put out there, because a lot of the times that people that we're dealing with are people that have had a bad experience or tried to do it themselves, or maybe had a bit of an issue. The other thing is obviously budget. So how much will you end up spending? Do you really know what it's going to cost for town planning charges? Do you know what it's going to cost for council approval? Have you even heard about a headworks charge, which is like a council contributions charge, which can be $30,000 added to the cost? And sometimes, depending on which council you're using, they can actually send you a bill after you've finished the build from the council. So do you know about all of these charges, and do you really know what the full turnkey cost is going to be? So that's just something to consider. Location, we sort of touched on this a little bit earlier, but do you know the best areas to, I guess, look at duplexes? Do you know which areas accept dual locks? So, a big thing you'll find with dual occupancy is that there are a lot of suburbs and a lot of areas that the council just will not approve it, will not have it. So, for example, in Queensland, we've got a couple of areas, Moreton Bay, Logan, Ipswich, Caboolture, but a lot of other councils in southeast Queensland just will not approve it. So do you know what you're dealing with, who the town planners are to deal with in each location? And look, as we said before, like with granny flats, a simple thing you've got there is that Victorians, in Victoria, you're going to have to look at, if you're building a granny flat, then you're only allowed to have a family member realistically living in the granny flat. So it's a lot more research in locations, what your council's regulations are, or what the investing council where you're going to be investing. Quotes and planning. Do you know who to use? Have you used these builders before? Do you know which builders are reputable? Can you get multiple quotes? So is it easy enough for you to go and talk to 5 or 6 different builders and see which ones are going to be best and really get the best price, and then negotiate on that as well? Because you need to understand that usually with dual occupancies, for example, you're going to be on a smaller block of land than what a duplex would be, and a lot of the times the builds have to be customized. So you will find with builders, they will give you a margin of the expected cost. So it's really pays to know and at least know your builder, or get a full understanding of it all before you sort of lock in anything. And that does make it a little bit harder on your or to control your feasibility study when you're looking at what your expected spend on a build or whatever it may be, and then to what will actually come out. So it does make it a little bit hard. So acquisition contracts. So once it's purchased, who's going to help you? Do you have anyone to help negotiate, or do you know how to negotiate with builders? Can you afford delays? So if there are any dramas as far as something comes up with any types of build, can you afford to wait 6 months, 8 months for a build? And these things can happen when you are dealing with customised build projects. So you've got to be really in the right frame of mind. And I'd say, as I said before, the people that are interested in doing it themselves, I would imagine already have the experience or been through it before. And that's something that I guess I find a lot with the clients I deal with. Okay, so we're just giving you a bit of example. Now, this is really going to be basic. So I understand some people out there might have multiple investments. Some people might only have the one. Some people might be looking for their first property, whether it be a PPR or an investment. So it's a very broad scope that we could be dealing with the people that are listening, but we'll just keep it simple and let's just look at a simple, I guess, cash flow positive strategy. So if we're looking at adding a dual income to just a simple PPR, so let's say you've got your home and it's worth, you owe 500,000 on the loan, you've got a combined income of 120 grand a year, you're using an offset account. In this graph here, you'll see that we've actually factored in that it's got about a surplus savings of around 5%. So after your expenses each year, you're putting away 5% each year into your offset account. So that is building as we go. So on a normal loan, if you, not have an offset account, it's just a 30-year term. That's straightforward. But if we're using an offset, we're putting 5% away each year on an interest rate of 5%. Again, generalised over that whole term, but 5%. Using that little bit of extra savings with the offset account, you're quite easily knocking off 6 years off your mortgage. But then again, that's acknowledging that you're keeping that 5% in your offset account as you go throughout the whole term of the loan. So, yeah, so if we move and we're looking at, let's say, at a dual income property, so you'll see the figures here change quite dramatically. And this is just going off one of the examples that we were using earlier. So the main things that we're looking at here is your after-tax cash flow. You'll see in year one we're looking at $10,315 is your after-tax cash flow. And then year three, 7,000, year five, 7,000, year 10, going back up to 9,000. So if we average that out to $8,000 extra per annum, another thing we sort of recommend, in which we're finding a lot of not too many people have heard of, is income tax withholding variation. So it basically means with your tax return that you're getting each year, you just organise it with your accountant, but you'll be getting paid that monthly into your account or from the government, or however you set it up with your accountant. So that can regularly be paid out rather than a lump sum at the end of the financial year. So what we're looking at here is essentially using that $10,000, or actually we averaged it out to $8,000 on this one. So that $8,000 each year, adding to your income, you'll notice the actual expenses, percentage of expenses drops because your actual profit margins, I guess, if you want to look at it like that, are increasing. So you'll notice that drops. But if we go back to the first one, you're paying your loan off in 24 years by simply adding one dual occupancy with a positive cash flow, you're knocking it down by 8 years on the loan. And the other big thing is you're saving $135,000 in interest over that term. So for the people out there that have got, let's say, a couple of investment properties that are negatively geared, by adding an investment property with a dual income that is positively geared, as long as it's in the right areas and you do, obviously, your feasibility, everything adds up and it is the right investment, and we're walking away with a positive cash flow after tax each year, then it's going to help you turn your negatively geared portfolio into positively geared, and that's something that we look at quite closely. And if it's within your budget, it's something that we do like to recommend a lot of the times, depending on if it's aligned with what the best plan is with your strategy. So I guess just some advantages with what we do in having guidance, and as you said, as a lot of people did mention, that they do like to have a bit of both. So we find that most of the clients that I deal with, they do like to be hands-on. They like to, I guess, do all the research and assess it all, but at the end of the day, they do love the fact that we give them an expert opinion and I guess hold your hand throughout the whole process. So a lot of the challenges as far as what we were saying before, when you're doing it yourself, your experience level, yeah, I mean, your budget, how much do you know you're going to be spending? Like we develop a strategy moving forward, but I guess the other side of things is more so we only deal with full turnkey packages. So you'll notice that when we're I guess packaging up we're looking at a dual lock or a duplex or anything of that case to build, if we're going new, we include all the planning, the council approvals and everything. So you're not going to be left out of pocket, and you're not going to have those trip ups. Like we've got a whole team that look after project management. They do subdivisions, renovations, and specialise in dual occupancy residences. So they know the whole step from start to finish, and we can hold your hand along the way. So we actually give a bit of support in that direction. Simple planning throughout the process, so timelines. So a simple thing as far as, okay, if you're going to go into a build and you haven't done one before, or you haven't done a dual lock or a duplex, as I said, a dual lock is pretty similar to your normal house build because the size of the house is generally pretty similar. Duplexes, we have a little bit more hurdles to go through with council approval, getting your DA, and it can take a lot more time. So having that process where you know what the timeline is before you go ahead, you know, okay, all right, I'm going to be looking at an 8-month project here, or if it's a dual lock, okay, it's 4 months, and we've got a little bit of I mean, a lot of the times we'll deal with a bit of security in the fact that a lot of the builders we deal with, we can arrange to get a bit of insurance to make sure that the build time is finished on time. If not, then they'll recoup the cost back to you as well. So that definitely helps, especially with this. I guess the biggest thing, if you want to be a bit of both, and that's something that a lot of people are talking about, is that we're completely transparent. So everything we do, we're explaining to you. So if we're looking for, let's say, the perfect place for a dual lock or a duplex, we're going to be telling you why we're looking at this area. What's happening? Is there going to be new shopping centres? Is there going to be hospitals, public transport systems, the infrastructure about what's happening? And when we cover all over Australia. So I guess everybody can jump online and do their searches, but do you know about the new shopping centre that's coming in south of Melbourne? Do you know what new freeways are being built on the north side of Brisbane? Do you know all of that? Obviously, you'll have it in your scope, but when you want to look at investing outside of where you live, for example, a lot of people in Sydney, whereas, I mean, this sort of build for 700, 800,000 is pretty unrealistic unless you're out in the sticks. You want to start looking at maybe some other cities. That's where it sort of pays to have some feet on the ground and help you with that. So that's something that we do. Obviously, we've got a small fee involved for us to help you with this, nowhere near the costs of what you'd actually find with, I guess, buyers agents or project management companies. And I guess we incorporate everything for what we do. So everything we're reliant on obtaining finance approval. So if anything happens in the finance phase, you get your money back. So the biggest thing with us, again, as well, is that our company is built on education and helping people get into the right properties. So we've been around for 10 years, started off as a real estate investment magazine. So we aren't a company that's out there just looking to sell you properties. We align ourselves with helping through the process, which is why, I guess, when you jump on board in what we do, we give you a strategist such as myself to map out the best way for you to build a portfolio from now until retirement. You'll get your own property agent, which is a buyer's agent, but without the fee, and you get a contracts manager who helps you throughout the whole process to make it a smooth process. So there's a lot involved rather than just sort of putting a property in front of you and hoping that you buy it, which is you'll find a lot of investment companies out there are doing these days. So our background can really separate us, and that's why we say use our experience, use our professional ties. Even when it comes to getting quotes for builders, I mean, we can get 5 different builders quotes in 3 or 4 days and come back to you with two or three of the best ones. That sort of stuff is easy for us. We do it all day, every day. So that's an advantage, I guess, when you're getting guidance. If you go new with us as well, we organise with builders, developers to get you a $5,000 rebate back. Usually if we're dealing with builders, developers, they're not having to pay marketing fees or real estate agents or commissions. So we basically will say to them, if our client wants to use you, you have to give them a $5,000 rebate. So essentially what you're paying us can cost you nothing because you'll get that money back if you're going with a new project. Obviously granny flats building, and I mean purchasing existing and building a granny flat, different case, but I mean it's just whatever's best suited to you. It doesn't mean we're necessarily going to point you in that direction. And yeah, look, we get exclusive access. So a lot of our stuff, because of our ties with our, as Dennis was saying earlier, with our board of directors being in domain and real estate, we get a lot of first-hand information from builders, developers, real estate agents, solicitors, land agents, just information on, I mean, projects or new up-and-coming developments as far as master plan communities. So we get a lot of that information sort of first-hand before it hits the retail market. So you'll get a lot of that sort of put in front of you if you're looking for it. Completely transparent, as I said, and a team to work with you. So we work with you throughout the whole process. So yeah, I mean, if you're in the position where you are, I guess, looking for a bit of guidance, it doesn't hurt to sort of get that little bit of extra help. So last poll, I mean, if you do want a bit of guidance, more than welcome. I'm happy to have a chat to you guys and go from there. I've got one fee that says, what are your fees for the guidance? Well, it's a part of our premium service, so it's a once-off fee. You're looking at $4,995 if you choose to go down that track. And as I said, if you are getting something new, so if you're looking for a dual lock or a duplex and we're going to build and help you throughout that process, you'll get the $5,000 back from you. So that's the fees for that. I've got a couple of other questions. Are you affiliated with Positive Real Estate? No, they're definitely a separate company. Another company more focused from what I see. I'm not here to, I guess, say anything bad, but I know that they focus strongly on selling their properties, but they do a bit of education as well.